About this video. This video introduces options trading. An option is a financial product or instrument whose value is based on the value of an underlying asset, such as a share. Options trading offers significant potential benefits to investors, but is considered a high-risk investment that carries the risk of making significant losses. Options trading is not suitable for all investors. If you are considering options trading, we recommend that you seek all necessary information and advice before starting to trade. The video is prepared solely for information purposes and does not constitute financial advice. None of the information contained in this video constitutes an offer or solicitation to buy or sell any financial product or instrument, to make any investment, or to participate in any trading strategy.
In the last lesson, we learned the basic concept and purpose of options. Next, what elements does an option contract contain? The first element is the underlying asset. As we already know, an option is a contract. The underlying asset is the asset the contract is based on. If you buy individual stock options of Tesla or Apple, the stocks of Tesla and Apple are the underlying assets of the options. The trend of options is closely related to the performance of the underlying stocks. In addition to stocks, underlying assets can also include indices, ETFs, futures, and other securities. The second element is the option type, call or put, which was discussed in the last session. The third element is the expiration date, which is also one of the biggest differences between stocks and options. You can hold on to stocks forever, but not options. After the agreed time, options become worthless. The next question is whether options can only be exercised on the expiration date. The answer depends on the type of option, American options or European options. American options can be exercised on any day up until the expiration date. European options can only be exercised on the expiration date. Most stock options are American options. Index options are usually European options. Buffett often sells long-term put options on indices. Why? Because as the index option is normally a European option, he doesn't have to worry about it being exercised because of short-term fluctuation. In addition, most US stocks have weekly options and monthly options, while Hong Kong stocks generally only have monthly options. The monthly options of US stocks expire in the third week of each month, and the monthly options of Hong Kong stocks generally expire at the end of the month. Relatively speaking, there are more options for US stocks, with relatively better liquidity and larger trading volume. Among them, the options of well-known companies are the most popular, such as those of Tesla and Apple. Very long-term options or those of less well-known companies have little liquidity, so it's best to avoid them. Strike prices and premiums are two elements of option trading that beginners easily confuse. The strike price is the price at which the buyer and seller agree to buy or to sell the underlying asset, as mentioned in the last session. For example, if they agree to buy Tesla at $1,200, then $1,200 is the strike price. The concept of option premiums was also mentioned in the last session. We should highlight here that what is traded between option buyers and sellers are not stocks, but contracts. Each contract has its own independent market trend. They are derived from the underlying assets, the stocks, and therefore we call them derivatives. A stock can have numerous options contracts, and the premium for each varies. The sixth element, contract size, is the asset quantity under contract. One US stock option contract corresponds to 100 underlying shares. For example, one Tesla option contract corresponds to 100 Tesla shares. The corresponding relationship between Hong Kong stock options is not fixed. For example, one Meituan stock option corresponds to 500 shares. You should carefully check the corresponding quantity when trading. Otherwise, you may contract for too large a premium by mistake. Note that the premium shown in the option market is the price for one share. When buying or selling one lot, the actual transaction amount will equal the premium price for one share multiplied by the contract size. For US stock options, the contract size of one lot is 100. If you want to buy an option contract of 100 shares, please do not input 100 when you place an order. This means 100 lots, which equals 10,000 shares. Finally, I will show you what the option chain looks like. There are two forms of option chains, list quotations and T-type quotations, which can be set up in the app. The T-type quotation chain looks like this. The upper part shows the expiration date, the middle shows the strike price, and the left and right slides are call and put respectively. Their closing price is the premium. Okay, in today's session, we summarize the 6 elements of an option contract. We also know that the option buyer has to pay the seller to obtain the option. So how much is an option worth? Why are the premiums of different option contracts of the same stock so different? Let's talk about all of this in the next session.